Hello everybody, my name is Mark, and in this video I am going to go over how you can qualify and invest in the 4 different levels of options. Now, to start out, I would like to say that if you open an account with an online broker, you can't just put money in there and buy and sell options. You have to get approved to do that, and there are reasons for that. Which I will not get into in this video, but just know that you have to get approved due to the kinds of risk you're taking in leverage. So in order to do that, the first thing you would do is you would go to, and this is TD Ameritrade, you go to Client Services, you click on General under My Profile, and then you go to Option Trading right there, and you click on Apply for Upgrade. And then voila, you put in your full name, and there are 4 levels of trading that you can do. The first level, the first level, hold on here, why is it keep, okay, first level being Tier 1, covered, writing covered calls, cash secure puts. The second level being the same thing as the first level, but with the addition of purchasing option. Third level being doing spreads, and then the fourth level doing all the other 3 levels, and then finally writing uncovered options. So I'm going to do videos on each one of these levels, and I decided to break the video up into the 4 levels or 4 parts, otherwise this video could go on pretty long. So I think it's better that I focus on 1 level at a time per video. Okay, so in this video, I am going to go over how to qualify and start investing in the first level of options trading or options investing. Okay, so first thing you have to do is you got to get qualified, and what I did was I started out, I didn't even try for these upper levels. I started out with the first level right here, and then for about 6 months or so I sold covered calls and cash secure puts, and then I applied for level 2, and then for a few months I purchased options, and then I went for the next level right here. I got a margin account and I did some spreads. And this one you'll notice is not even grayed out, and that's because I don't even have this level. It's the highest level. And the main difference here is you can write uncovered options. And when you write an uncovered options, you're taking on some risk, and you could possibly get a margin call if you're not careful, because your options are uncovered. And I will explain more about that later when I do a video on that level. So in this video, we're going to start at level 1. Okay, so you have an account and you're applying for options, right? And you clicked on the client services, you clicked on general like that. Let's see, did it work? Okay, maybe I need to go back. Let's go back here. Let's say I'm on a stock, and then I go to general, and then I go to apply for upgrade, and now I want to get level 1. So I put in, you know, Mark whatever, and then I can't actually fill that in. If I could, I would do it like that, right? But I'm not going to do that. So you want to get level 1, and you click the little dot, and then you put what are your investment objectives, and you put whatever your objectives are, and then you put your employment status, and hopefully you have a job, and then you put all this information down here. Here you put how much money you have approximately, your average transaction you're going to be making, the types you're going to be doing, and of course you'll want to pick options. You click the agreement, and then you submit, and then step by step you just follow the directions. And of course, if you get stuck, TD Ameritrade and most brokers will have a 1-800 number that you can call. So when you get level 1, that gives you the ability to write covered calls and write cash secure puts. Okay, so level 1, what is writing covered calls and writing cash secure puts? First thing, do not get tripped up by that word write. Okay, when you are writing covered calls and you're writing cash secure puts, what you're really doing is you are the option seller, and you are selling call options or put options to the open market, and you are being compensated for that. Okay, you're not writing anything. All of the options are already out there on the option chain, so do not get tripped up by the word writing. When you are writing covered calls or writing cash secure puts, all that means is that you are the option seller and you are selling contracts to the option buyer, and whoever the option buyer is has the right to buy or sell shares of stock, 100 shares per contract from you, and that's what you do. And the key is that they are covered. Okay, and so Tier 1 or level 1 is the lowest or the most basic. It has the least amount of risk. You cannot lose money on the option. You can only lose money on the underlying stock value. Okay, and so I'll give you an example on how to do that. So let's bring up General Motors, and I picked General Motors because General Motors, I'll pull up the 5-year chart, and you see over the last 5 years it's pretty flat, right? It's just goes up and down. It's got a high of about $40 or something, and it's got a low of like in the mid 20s somewhere. So we'll say like $25 or $6 to 40, right? And this is over the last 5 years. And then this was, what happened before the recession. Go to the 10-year chart, and during the recession, General Motors got hit hard, and they were restructured. The government bailed them out, so they even reset their stock, right? And so they've been up and running ever since, and they've been a pretty neutral stock. Okay, so on neutral stocks, selling covered calls and selling cash secure puts is a pretty good strategy to do. Okay, so let's go to a 3-year chart. Now, as of right now, the making this video, General Motors is at $33.29, and you can see the chart is showing a range. So this would be a range-bound stock of, here it goes up, and then it goes down, up and down, and then up like this, and then down. And so it's got a range of the upper 37s to about the lower 27s, and it's right smack dab in the middle. So let's go over writing a cover call first. So and this is level 1, right? So again, as a quick review, General, apply for upgrade, and you see level 1 here. You're writing a cover call. So when you're going to write a cover call, let's say that you want to buy some General Motors. It is a range-bound stock, and you buy 100 shares. So $33.25. You would need $3,325. You have that money. You own 100 shares, and now you sell a cover call, and you say, okay, well, it's a range-bound stock. It's got a high of about 37, so maybe I'll go 6 months out, and I'll choose a $36 price, so that I would click on this stock, I'd click on that option right there, and it looks like that it's worth at about, let me close this out. The premium is 65 and 66, so let's say you get $65 for that. So all stock options are multiplied by 100 shares, with very few exceptions. There are exceptions to that, but 95% of the time, stock options is 100 shares per contract. So what you would do is first you would buy 100 shares of General Motors, right? You click on the buy, and then you go down here and you put in your 100 shares like that. You click the review order, and there you go, $33,325. I'm not going to place the order because I do not want to buy 100 shares myself. But for the video, you bought 100 shares, and now you're ready to sell a cover call or write a cover call. So you click on option chain. Now on the option chain, you see there's all these different dates, and you could pick a short-term option, which you see how cheap they are. You don't get hardly anything, right? Or you can go a long ways out, but that's 626 days. Who knows what's going to happen that far out? And even though you could get lots of premium for that, you could choose $40 call and get $1.34, $35, right? But who knows what's going to happen in 626 days. So you want to be kind of in the middle somewhere. And so you decide to go 136 days out. That's about 4.5 months. So in 4.5 months, you're going to pick $36 strike price, because that's the range. If you remember, it had a high of about 37 and a low of 27. So you're going to sell a call option to the open market for a strike price of $36. So you click on that, okay, and you click the action, and you'll see you got 4 choices. You can buy to open, buy to close, sell to open, sell to close. Okay. Now, if you were going to buy the option, you just click buy to open, but you are selling the cover call, so you sell to open. And the good way to remember that is when you are entering into a contract, the contract is open, and when the contract comes to an end, you're closing, and then the contract is closed. Okay. Now, you are the option seller, so you are going to sell to open, which means that you are shorting the call option. Now, shorting call options is a safe thing to do compared to shorting the stock itself. Okay, shorting the stock itself, you're borrowing shares of that stock from your broker, and then you sell those shares to the open market, hoping that the price of stock goes down, and then you can buy them back for a cheaper price. But for when you are selling the option, okay, going back to the option chain, all options are worth a premium. That's one of the differences between stocks and options. With stocks, you just buy for whatever the share price is, which is $33.22, right? But these stock options are worth different premiums. So each of these call options is a contract to buy 100 shares of that stock per contract at whatever price. So like this $35 is a contract to buy 100 shares of General Motors at $35 per share. This one's $34, $33, and so forth. Okay, so you being the option seller, you are selling a call option to the open market. And so if you were to pick $36, then you want to click on that right there. And then again, you go back here and you are opening the contract. And because you're the option seller, you click on sell to open. And then you put in your one contract like that. And then you click review order, and you can see right there, estimated total $66. And you'll notice that there's no negative sign. That's because it is a credit. You are taking in a credit, and that's one of the cool things about being the option seller, is that the money gets added to your account instantly, and it goes into your cash reserves. So it's kind of cool. It's almost like winning the lottery, if you will. And then you click place the order, and voila, you now you don't own the option, but you have shorted a call option. You have written a covered call. Okay, and then you are going back here, you're going to wait out the duration of this 136 days. And so in 4.5 months, if the price of General Motors is at $36 or lower, then you collect this 60 whatever dollars that you made, and you call it a day. Okay, if the price of General Motors goes above $36, like let me go to these out of the monies here. If the price of General Motors goes up here, like to $37 or $38, let's say the price of General Motors, you know, right now it's at $33.21. The market's open, so it's changing up and down like stocks like to do. But let's say you sold this covered call and the price of General Motors goes above $36, and let's say it blows past and goes all the way up to $40. Well, what's going to happen? You own General Motors, which is at $40 per share, but because you are the option seller, you will automatically sell 100 shares of your General Motors stock, which you bought all the way back when it was $33.22, and you're going to automatically sell it for the price that is in this call option. Okay, and you might think, well, wait a minute, that's no good. Okay, the price of General Motors is $40 and I'm selling it for $36. I'm taking a $400 loss. But what you're forgetting is that you bought 100 shares of General Motors at $33 and some change. The price of General Motors went up to $36, so that's almost $3 a share. That's like $2.80. So you're going to make that $280 plus the money you collected on this premium. 280 plus 66 is $340 something. You're going to make $340 something on a $3,322 investment. That would be a 10% return in a 6-month time frame. So that's the basic idea of selling options. Okay, and so when you are starting out as an option investor, that's the first thing you do. You go to apply for upgrade, and you click on this one right here. You just go from one level at a time. Don't try to go for all of them at once. Just go from one level at a time. That's what I did, and then I did this stuff for about 6 months, and then I went on to level 2, which has the same thing, but the addition that you can buy options. You can be the option buyer. And then I went to level 3, and level 4, I'm not even there yet, and I don't even know if I want to go there, because I don't feel comfortable writing uncovered options, because when you write uncovered options, that's the opposite of writing covered options. You're right here in the beginning level. In the first level, you're writing covered calls and cash secure puts. And remember, don't get tripped up by the word writing. You are the option seller, and you are selling call options to the open market, which means that you are selling contracts to buy or sell 100 shares per contract from you to an option buyer. Okay. But the key is they're covered. When you are doing it uncovered, then that's a completely different ball game. And in this case, you can lose money on the option itself, and that's why it is stuck there in the advanced. Okay, so the first thing you do is get that level 1 option approval, and then start writing covered calls. So all you got to do is pick a stock that you really like. Okay, maybe you don't like General Motors. Maybe you like, let's say, Facebook. Right? Facebook is a good stock, isn't it? So maybe like Facebook, and it's $153 per share, so you'll need $15,324. So let's say you got that. Okay, you buy 100 shares, and let's be professional. Let's look at the chart and see what they've been doing. Okay, they got a nice uptrend, don't they? Nice uptrend. Okay, so maybe with them, you might want to pick a higher strike price. So let's say 6 months out, and it's at $153.25 per share. So you need $15,325. You got that, and now you're ready to look for a nice stock option. So let's go kind of out of the money a little bit, and let's go to let's see. Let's go up 10%. So 10% of $153 would be $15. So let's do $165 here. So $165 in 6 months. Looks like you're going to collect about $385. Okay, so let's click on that. Okay, you like Facebook, you buy it, and then you're going to sell to open that one. Okay, and then you click in the one contract like that. You review the order, and walla balla, $390 gets added to your account. Okay, and then in the next 6 months, you have sold a call option to the open market, and so you wait for 6 months, and if it goes up to 165 or past, not only do you make let's see, 100 shares. Not only are you going to make $15 per share, which would be $1,500, but you're also going to make this extra $390, okay, per share. And that $390 looks like it's about a 2%, almost about a 2.5% gain. So you're going to make about a 12.5% return on your money by doing that. So that's an example of cover calls there. Now I want to go back and go over the other part of the option trading. So let's go back to client services, go back to general, and we'll click on upgrade, and you're getting a good repetitive lesson on how to upgrade for options, at least on TD Ameritrade. You apply for the upgrade, and so we went over writing covered calls. Don't get tripped up by the word writing. All you're doing is you are the option seller and you're selling contracts. Now we're going to go over writing cash secure puts, which is selling put options to the open market. And again, you are compensated for that. So let's go back to General Motors. Okay. Now, call options are contracts to buy 100 shares per contract. Put options are contracts to sell 100 shares per contract. Okay, and so in this case, you want to sell General Motors, and again, when you are the option seller and you are writing covered calls or cash secure put, that is considered to be a bullish strategy. You believe the stock is going to go up, and so you like General Motors, and again, you're going to go 6 months out. Okay. And in the case of a put option, you pick a price that you think that the price of General Motors is going to be at least that price or higher. Okay, so let's say $31. Okay, so because you're picking a $31 put, you would need $3,100, and that would secure your put. And I'm going to go back to the options real quick to explain what that means. Okay, so again, apply for upgrade, and here you go. Okay, you're writing cash secured puts, the keyword being secured. When you are writing cover calls, the keyword is covered. Okay, and the reason why it's covered is because you own 100 shares. Well, in the case of puts, you have the money sitting in your account just in case the value of the stock goes below the value of the put option that you can sell your stock at. Okay, so back to the General Motors here, and back to the option chain, which is the place where you go option shopping. Now, you like General Motors, but you don't want to, instead of buying 100 shares, instead what you're going to do is you're going to take the money that you would have spent on the 100 shares and you're just going to let it sit there in your account. Okay, and you're just going to, and so in the case of a $31 put, put options multiply times 100 shares per contract. 31 times 100 is $3,100, and you are going to sell this put option right here. So you click on that, and again, you're going to click sell to open. You're going to click 1, and you are compensated in the amount of premium. So if we go back here, you can see that the $31 put, the bid is at $110, the ask is at $1.11. You're multiplying that by 100, so $110, $111, and so you multiply that times 100, and so again, you're like, that sounds good to me, so you set aside $3,100. If you're going to do the 32 put, then you would set aside $3,200, because 32, this put option gives, you are selling a contract to another person to sell 100 shares to you, so that in 136 days, if the value of General Motors goes below that, then you will automatically buy 100 shares from that option buyer. Okay, that's what happens when you are an option seller. You are giving other people the right to buy or sell 100 shares per contract to you. So you've chosen $31 put. So you need to set aside $3,100. You've done that, and now you click on the option, and again, you want to open a contract, and then you are the option seller. So you are selling to open. Put in your one contract. Click review order, and there you go. Kala bing, $111 gets added to your account instantly that you put place order, which I'm not going to do. But if you were going to sell that put option to the open market, then you now have you have invested money, and you are now opened a position, and this is one of the ways you can make monthly income on selling put options. I apologize if I'm rambling here, or if I seem to be stuttering, but this video turns out seems to be a little more to it than I predicted. I never realized how much it would take to explain stuff like this, but I hope that you guys are able to follow me and keep up with me. If not, you're always free to ask questions in the comments section. Okay, but that is level 1 of option trading here. So again, first thing is you apply for the upgrade, because you can't just buy and sell stock options. You have to get approved, and then start at the low level. Do that for a few months. Write some covered calls, meaning sell some covered calls, sell some cash secure puts. Be conservative, you know, don't go crazy. And then after a while, you'll be ready for level 2. Okay. Now, back to General Motors here, and back to the option chain. So you've sold your $31 put, and now you wait for 136 days. And if the price of General Motors stays above $31 per share, it's at $33, then you get to collect $111. Now, if it goes below, let's say it goes down to $30, then you're going to, well, actually, you wouldn't lose money because you collected $110, right, which would offset the loss. Okay, but let's say it went down big. Let's say it went down to its range. It went down to $27, and it expires on 136 days from now. Well, what's going to happen is that you will automatically buy 100 shares of General Motors at $31 a share, and then you will. And then the value of General Motors would be at $27, so you would instantly lose the $400, but you do have this $110 of premium which you collected, right? You collected that when you opened the contract. You sell to open. This is what it means to write put options. You put in a contract, and you click review order, and there you go. You get 112. So you would have lost 400, but you would have made 112, so your net loss would be about $290 and some change, I guess. But that's the risk you take when you are an option writer. You could lose money on the value of the stock. You cannot lose money on the option itself because you are taking in a credit and you are covering. That's why it's called covered. So again, go into General, apply to upgrade. Level 1 is covered, writing covered calls and cash secured puts. Okay, writing uncovered options, that's a little bit more risky, and I will explain that in a later video when I get to this level. So hopefully I was clear enough in trying to explain all the ideas of applying for options trading levels approval. There's 4 different levels, and when you first start out, just go for level 1. Write some cover calls, sell some call options, sell some put options. Do this for a few months. Be conservative, and then go for the next level. Okay, and the next level is the same thing. Okay, you see level 1, you write cash secure puts, you write cover calls. Well, level 2, you're also writing cash secure puts, you're also writing cover calls, but you get an extra bonus. You get to purchase option, and in that one, you are the option buyer. And that is the next video that I am going to do. So thank you for watching this video, and I will see you in the next video when we get to this level 2.